Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 325th VideoCast podcast for the week ending January 6th, 2026. A lot of great stuff to cover this week, but as always, family first. Want to congratulate Annabelle. We went up to San Francisco this weekend, and they put this out. 11-year-old from Irvine Nova Aquatics, Sam, personal best in 4 events in the girls' competition, winning 3 of them. Hayes topped the field in 50 back, 28.59, 100 back, 101.47, and 200 IM, 211.79. Also swam personal best in 200 free, 159.99 to take second in that event among 11-year-old girls this season. Hayes is, by the way, she's 12U right now. Hayes is first in the 200 IM, third in the 200 back, fourth in both the 50 back and 50 free, another 11-year-old in the girls competition. So that's that. And then this was interesting. Probably should be in another section, but I wanted to cover a couple of things. This is from Peter Lynch, Ways to Improve Investment Performance. In section 1, you need an edge to make money. Do not rely on a combination of hope and good luck. I can't tell you the number of people that say, I hope this happens, I hope that happens. Hope is never a strategy when it comes to investment. It usually has something to do with arithmetic, okay? If you're not making decisions on the basis of math, either A, find another pastime, or B, get damn good at analyzing businesses. And that's what we try to help you with every week at Hedge Fund Tips with Tom Hayes. The second thing I liked from his list was if a stock is going down and the fundamentals are the same or better, purchase more shares. And we did that in spades with Baba. We're doing it in spades right now. And we've done that. That's kind of our knitting. That's basically what we do. When we think the margin of safety is large enough, it's not just because it's going down and the fundamentals are the same. It depends on the starting point and the relative valuation and all the other things. But the basis is if you've done all your work and the stock, you've entered a position, stock moves against you and you can add more, you add more. And that's what enabled us to have such a low basis in Alibaba, starting higher and bringing the basis all the way the hell down, that it tripled off the bottom, and now it's going to double again over the next few years. So we're excited about that. Next, here's a picture of Annabelle up in Pacifica this weekend we took, and that's that. She's also now number 1 for all 11 and 12-year-olds in the country for IMX. IMX apparently is a measurement that they use that encompasses like all strokes and everything. It's like best overall comprehensive measurement. Okay. This morning, I had the pleasure to join the great Stu Varney on Fox Business to discuss 2026 outlook, markets, gold, and more. I want to thank Garrett Collins and Stu Varney for having me on. We're going to listen in here.
Down 40. Tom Hayes joining me now. I really feel that this Venezuelan oil news is bullish for stocks. Do you share my opinion? Do you think this might start a new leg for the bull market?
I'm not sure about a new leg, Stu, and for the last 3 years I've been a raging bull.
Yep.
It's going to take about 3 years to get this oil out. The marginal cost of production is higher per barrel. It's going to be a good thing net for inflation, but as far as the rally goes, midterm election years tend to be a little weak. I think the market's going to hold up through the first quarter, a little weakness into the election, and then strong into year end. But if you go back to 1948, Stu, the average return of the S&P is about 4.9% in midterm election years. So curb your enthusiasm. I know we're going to touch on 50,000 here in a couple of days. The better question is, when do we get 60,000? And that's not going to be a 2026 answer. I think it's a 27 or 28 answer.
You got in front of my next question. My next question is, I've got 2 numbers for you. 50,000 on the Dow and $5,000 per ounce for gold. When are we going to hit those 2 numbers?
All right. Well, as it relates to the market, even though I'm subdued on the indices if you're passive. I think fortunes are going to be made under the surface of the stock market this year, Stu, in the broadening rally. So the top 10 weights that have led things are going to do poorly this year. The unmagnificent 493 are going to do a lot better. So there are going to be a lot of double triples in the stock market. As for gold, rarely does chasing shiny objects end well. Okay, so right now, while retail traders are chasing gold at 4,200 and maybe they'll get 5,000, I would tell you this. I look at the commitments of traders reports every Friday from the CFTC. And while retail buyers can't get enough gold at 4,200, commercials, the ones with the knowledge in the field, are aggressively record shorting gold. So commercials are always early and they're always right. So could it go to 5,000 first? Sure, it could go to 5,000 first, but it won't end well.
But back to my question on the Dow Industrials, 50,000.
Yeah.
Are we going to get there this month, January?
Yeah, 50. It's 1%. Absolutely, we'll probably get to it in coming days. I think that the market holds up. As far as a new leg of a rally, though, Stu, okay, I think you're going to have to curb your enthusiasm there. We'll have some good stocks for you this year. A lot of doubles throughout the year, but the passive indices are going to be a little more subdued for you.
Tom Hayes, thanks very much indeed. Curb your enthusiasm, he says.
And we're back. On Monday, I had the pleasure to join my friend Lou Bassanese and another friend, Adam Johnson. I call him AJ, on Lou's podcast, The Big Skinny. We're going to listen in here.
Tom Hayes and Adam Johnson, AJ Insights. They're joining us live. Forget the break. We're just going live to it, guys. Nothing like being on the hot seat. Welcome to The Big Skinny for your second, third time. I appreciate you joining me live.
Oh, thanks for having us.
All right, jump ball here. Who wants to share their first top stock pick of 2026 and why the market's got it wrong and you got it right?
Well, I'd love to here, Lou, just because it's a relatively new position for us. As you know, I've earned the nickname Turnaround Tom on Wall Street, and this is another turnaround story that we've initiated literally over the last number of trading sessions since right around Christmas through now. And it's a company that's down 83%. It's called Dentsply Sirona. The ticker is X-Ray. Our basis is $11.37 across all accounts right now. And this is a very cyclical business. And
so why do you like it right now?
Well, look, why we like it right now is because healthcare, as a sector, is poised to recover massively in 2026. Dentsply is trading at 7 times earnings. They've got a new CEO who came from Globus Medical. He was there for 10 years, first as CFO, then CCO, then CEO. It was a 4-bagger over 10 years. This thing's got 5.78% dividend yield, which if they had to cut it, which is the key thing with the turnaround situation, they'd get $120 million of free cash flow. So the balance sheet's healthy. The free cash flow is healthy. They're the number one maker of dental supplies and technologies. And they've been around since 1899, Lou. They're not going anywhere. They're number one in the game. They're going to recover with the cycle. And we think this can be a 3 or 4 bagger over the next 3 to 5 years. We love it here.
I love the setup, love healthcare on an absolute and relative basis. It's undervalued. Appreciate that one. Let's go to you, Adam, and you've run an innovation-focused portfolio where Tom has picked them really well. I can't even give you a hard time. You've had too many big winners. But Adam, you've had huge winners that are growth-oriented. So what's the number one top stock pick for you this year?
Well, I've got 2 for you today, and I'm going to share the first one in alphabetical order, CleanSpark. This is a company, CLSK is the ticker, that is the lowest cost Bitcoin miner in the country. And that is because they have located their 33 data centers near very cheap energy sources. Yeah, they use some of the clean stuff, wind, solar, et cetera, but they're also literally positioned right on top of natural gas fields. So you don't even have to transport the natural gas to them. They're just able to run generators. You put the nat gas through the generator, spins a turbine, creates electricity on site. Super cheap. That's why they're the lowest cost miner of Bitcoin. And what's really interesting, the reason I decided to buy them, Lou, is because they are pivoting and they are starting to shift some of their excess capacity to data center mining. So, you can use the same setup, the same machines, the same electrical grid, the same capability simply for AI, and you get a much higher multiple on AI than you do for Bitcoin mining. Bitcoin, the price is so volatile, so they trade at a low multiple. This stock trades at a PE, it makes money, trades at a PE ratio of about 10 times. Well, now all of a sudden, you divert, call it 1/5 of the capacity into artificial intelligence, and now 1/5 of the company arguably deserves probably a 40 or 50 multiple. Blend those together, and that argues for a doubling of the stock. My target is quite a bit higher than the current price, which we're shown on the screen, $12.30. But I love this one, Clean Spark.
Where do you think it go? Tom thinks his first pick, Dentsply, could go 3 to 4x from bagger from here. You think Clean Spark, same upside potential?
Yeah, absolutely. I'm north of 50.
Yeah.
So,
no, look, I agree. I love this.
That's more than 4 times.
Yeah, I love this space. TerraWolf, Core Scientific, Clean Spark, Cypher Mining. There's a lot of great names here doing that pivot. So, all right, Tom, back to you with another pick. We brought it on the screen, so we stole your thunder, PayPal. But why do you like a new financial type of play in this market?
Well, listen, Dentsply was a brand new pick for us. PayPal, we've been stuck in for some time. The beauty of PayPal is this reminds me a lot of Alibaba, and you followed my Alibaba saga. You couldn't give it away.
Thank you for that.
We were buying it, and it's by the way just getting started. Tripled off the lows, is going to double again over the next few years with Baba. PayPal is the exact same setup. Revenues are growing. Margins are reaccelerating. Record free cash flow. You can't give the stock away. Record low multiple, 12% free cash flow yield. Look, they've got enough buyback authorization right now to buy in 28% of the company. They've reduced the share count by 18% over the last 3 years alone. Their Venmo revenues are growing 20%. Their buy now, pay later is growing 20%. Their ads business, they hired a guy named Mark Grether who ran the Amazon ad business and the Uber ad business. Oh, and by the way, they just happen to have the largest two-sided payments network in the world, 438 million active accounts. Everything is, record free cash flow, record revenues. All that's missing here is multiple expansion. When this thing gets going, just like Baba, you're not going to know what's going to be the turning point. But once it happens, everyone's going to figure it out all at once. You're going to get multiple expansion as the growth reaccelerates, and people are going to say at $140, $150, now's the time to get in. $200, they won't be able to get enough stock, and we'll be helping them out with as many shares as they want.
Yeah, so this could be this year's Alphabet. When I was banging the table at $150 a share, and then it ran to 300. You had to give it away. You couldn't give it away at the lows. So
yeah, and by the way, 6th largest stablecoin issuer in the world. So that's a free cherry on the sundae.
I like that. So all right,
and we're back. And one more word about Lou and AJ. You know them both very well. Lou is a paid Fox Business contributor. You see him all the time on all the shows. And AJ is a regular on Varney, as well as on specifically Mornings with Maria, all on Fox Business. Was glad to do that segment with them. Then I joined CNA, which is like the BBC of Asia. It's out of Singapore. Talked markets last night. We'll listen in here.
And for more, let's bring in Thomas Hayes, Chairman and Managing Member with Great Hill Capital. Tom, good evening to you. So tech and AI-linked shares have been the market's mood lifter on Wall Street, but with concerns around chip supply tightness as well as profitability still lingering, what's actually driving their gains, and how are investors reconciling the rally with those underlying risks?
Yeah, look, it's new money flows. It's the beginning of the year. It's Jensen Huang doing his dog and pony show in CES. So you saw a lot of rally here in the last 2 days. However, the unsung hero of today's rally was actually healthcare and medical devices were through the roof. So we're starting to see a continuation of the broadening rally theme, which we saw start late last year. And that's pretty typical of midterm election years, which tend to start off strong, but tend to be very subdued years in terms of overall returns for indices, tend to be years that defensives do well. And we started to see that already in healthcare. followed by some of the other defensive sectors today, in addition to a few of the tech. But if you look across the tech stack today, it was mixed. You had your Teslas down 4%. You had some stocks that were up a few percent, but overall, semiconductors and healthcare were the leaders.
And also, President Trump said he plans to revive Venezuela's oil industry. And against a backdrop of global oversupply in crude, how could that move influence oil prices this year? And what's your outlook for the energy sector as well in markets shifting geopolitics and supply dynamics?
Yeah, I think it'll have little impact on the price this year. As a matter of fact, we're actually constructive on the price this year. We own a company called National Oil Well Varco. They're the largest onshore and offshore drilling rig company in terms of sales, service, repair, et cetera. They're going to be a major beneficiary on the Venezuela ramp up. But the Venezuela ramp up is going to take 3 years, number one. Number two, the cost of a barrel of oil is the marginal cost to produce. And as everyone knows, the oil in Venezuela is very heavy and refining intensive and much higher cost than the current price at spot. So I think that there was a little bit of overestimation in the impact of oil prices in the short term. We remain constructive on the sector, particularly National Oil Well Varco, the servicers, et cetera. And this is also consistent with the types of stocks that do well in a Fed easing cycle, which we're in right now in the United States. The cyclicals are starting to gallop. Companies that have a significant portion of revenues abroad, dividend payers tend to do well in an easing cycle. And that's why you're seeing the healthcares, the energy yesterday, a little bit of the tech stack today really starting to gallop. But overall, you got to be a stock picker in midterm election years because the average returns, if you're just sitting passively in indices for midterm election years since 1948, NASDAQ is down on average 0.5%. S&P tends to only be up 4.6%, and Dow tends to be up 5.2%. So start to focus on those areas that have maybe been left behind. There are going to be a tremendous amount of stocks under the surface that go up 50 to 100% this year. But here's what I would say, Henry. They're not going to be any of the top 10 weights in the S&P 500 currently. Those stocks that are overcrowded, even if you saw a couple bids today, are going to be more subdued returns than we saw in recent history. And the big money is going to be made by the stock pickers under the surface, while the passive investors in 2026 are going to be left wanting more.
Well, Tom, markets are bracing for key U.S. job data later this week. And how pivotal is that print for the Fed's rate trajectory?
Well, we're not going to get another Fed cut for another few months. I think a reasonable expectation is 2 more cuts and done. That will be done over the next 12 months. We will have expectation of a more dovish Fed chair coming in just a few months. So that will help buoy the market. We do think the market's going to retain its strength as it does in midterm election years through April. Tends to get very weak from April through October in midterm election years, and then finish the year strong. But overall, subdued mid-single digit returns this year for passive investors is what we're looking for.
All right, Tom, thank you so much for your analysis. Thomas Hayes, Chairman and Managing Member with Great Hill Capital.
And we're back. And then quotes of the week. Buffett, whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. That's kind of the crux of what we do here at Great Hill Capital and Hedge Fund Tips with Tom Hayes. Robert Arnault, in investing, what is comfortable is rarely profitable. And then wasn't comfortable buying Baba down in the 60s, wasn't comfortable buying Cooper Standard down at $5.11. Wasn't comfortable buying Albemarle in the 50s. By the way, brand new announcement, ladies and gentlemen. Albemarle is no longer a position. We took all profits this morning on the entire position, nearing a 3-bagger in under a year. This is one of those rare instances that happens way before we expect it. We thought it would take 3+ years to be a 3-bagger. It did it in 10 months. So we don't want to be pigs, and we're gonna do that. Now, I do think this one's going higher, and maybe even a lot higher. I will say there's something called the IRR. So internal rate of return. So if I've gotten a 3-bagger in 10 months, I'm not going to replicate that type of pace of return. That's fine. But at some point, whether it's from 164 where we sold or 190 or 210, at some point, it's probably going to consolidate. And when it consolidates, it's going to take a year and a half before it potentially makes a next move higher. And I'm not convinced that it's going to make a next move higher. And when I looked at it, 3-bagger in less than a year, and I looked at still free cash flow negative, I said, yes, this is going to turn free cash flow positive, but a lot of that's getting priced in here. Not all of it. It's going higher, but we're not going to participate. We're going to be grateful and move on to the next and potentially find a new name in the materials space for 2026, and maybe not. We've got quite a few positions, so we'll keep that open-ended, but congratulations to you, clients, and listeners who have been able to benefit from that. That was a lot of money in a very short period of time. Want to thank everyone who's been sharing the podcast. I can't tell you the number of clients we've had come in this quarter who've been listeners because a friend or family member shared the podcast. They listened for 3 months, 6 months, a year, 2 years, made some money with us. And then they said, look, I got a business to run. I got a family to run. I'm already rich. I don't want to watch markets. And they just came in and put a lot of money with us this quarter. So excited for that. We're closed out on Saturday. Look, at some point, I'm not going to take $1 million accounts anymore. We're either going to go up to 2 or back to 5. That's not imminent. So if you miss it this quarter, we'll be open next quarter, etc. But we just want to be able to give the best service to every single account at all times. And to do that, we've had this thing open to allow everyone in for some time, but I think it's going to be a net positive, and it's not imminent. But just beware, if you're considering doing something, you should do it. If you're not considering doing something, it's not relevant to you. Want to also encourage you, we've been getting a lot of orders for these hats, and this is the easiest way to get questions about the podcast, so you can share it with one person each week, which is what we ask in return for the value that we provide. And when you order these, because we've been getting so many orders and so few pictures, please send in a picture wearing the merch to info@hedgefundtips.com so we can get you posted on the website with the family community here. We've gotten a lot of you, but not like literally 1% of the orders of people have sent in pictures. So let's do that, get it up there, and become a great community there. Let's get down to some data. Let's start with Slumer. We haven't heard from Slumer in a while, from my friends over at RBC. What he shows here, we've covered many times over the years, probably started covering it down here when everyone was nervous, is the 17-year cycle. And what this talks about is over the last 125 years, the market has a tendency to consolidate for 13 to 20 years and then accelerate for 17 or 18 years. And it's a 16 to 18-year cycle on the consolidation and a 16 to 18-year cycle on the appreciation. And we've just come out of the 16-year consolidation in 2015, according to this chart. So we're about 10, 11 years into it. And the implication would be we've got another 5 to 7 years of ups. And I agree with that. I think it could maybe even be a little longer. They're pointing to 2030. I think it could be 2030 to 2033, just based on demographics and everything else and what drives spending over the last 100 years and around the world. So you're going to get your 10% and 20% corrections along the way over the next 5 years. There's no question about it. You're all going to be scared like the world is ending. But I think this secular trend, supported by technology, productivity, more important than all of that is demographics. Average population, largest part is 34, 35 years old, still family formation, housing formation, et cetera. That's when people spend until their mid-40s and then they slow down. Although they didn't get the memo in Newport Beach, but it is what it is. so I think we got a lot of runway here is what I'm telling you. And so, for those of you thinking like, oh, the last year has been so unbelievable, should I get conservative? I mean, if you're thinking in terms of days or weeks, I don't know if that's the right or the wrong answer. If you're thinking in terms of years, it's the absolute wrong answer, especially because, the reason we set up our business to do separately managed accounts versus a commingled fund is that a lot of money tends to come in after big moves in the market. And in a commingled fund, that means you're putting people in stocks that are already doubled, already tripled. And that's not ideal because they can easily consolidate, pull back 15%. So we like to put new clients in those stocks we believe are just leaving the station, not already cruising at 30,000 feet. So even when you see the indices high and everyone's exuberant, there are groups that are at very lows. And usually when people are exuberant, what's at lows is defensives. And you can get them at multi-decade low relative valuations with incredible businesses and get exposure that way, and healthcare and all the things that we've been talking to you about over the last few weeks. So it's like, yeah, the indices are high, but if you look at the names that we can get started in and are getting started in, and things like PayPal with a huge margin of safety that we just discussed on Lou's podcast, it doesn't really matter what the general indices are doing because we're doing private equity in the public markets, meaning we're buying if we wouldn't buy the entire business and take it private at the price that is quoted in the market, we wouldn't buy one share. And that has nothing to do with what the general indices or, 5 stocks in the general indices do. Has everything to do with the underlying cash flow, balance sheet, income statement, et cetera, and the things that we cover here. So answer to your question, which you didn't ask, is a lot more runway. 5 to 8 years is my view. I think it's more toward the 8, but on the short end towards the 5, which implies S&P 14,000, with an S&P at give or take 7,000, which basically means the S&P can double again from here over the next 8 years. And that's a very realistic expectation. Here's the 3 to 4 year cycle they're talking about. Less important in my view. You can see on the monthly, we might be up against a little resistance. Maybe, maybe not. Weekly, same type of thing. There's bullishness, but not yet off the charts. Russell looks like it's literally just breaking out small caps. So, I mean, that, target, that's going to be a double over the next few years in small caps. So we've got small cap exposure we're excited about. The rest of the world is just breaking out. IFA, Europe, Australasia, Israel in the Far East. I mean, there's more opportunity. I mean, if you're looking at small versus large, if you're looking at value versus growth, if you're looking at everything versus tech, everything versus Mag 7, there's tremendous amount to do. 10-year yield looks like it's done its counter trend bounce, probably going to consolidate down here in the low to mid threes some point this year. Dollar it resumed its downtrend. When it breaks below this, will continue weakness for the next couple of years. That's normal. Canadian dollar, loonie still gaining strength. Hang in there, my Canadian friends. You're going to be richer than you know what to do with over the next few years as the dollar continues to weaken relative to the loonie. Gold looks like it's getting to a Fibonacci extension here. It's funny. I saw this meme on Twitter, and it had like these 500-year-old guys in like their underwear dancing by a lake saying investors who have finally broken even on their 1980 silver investment. So 45 years later, it's back to the future, back to the same price. I think oil here finding some support, which is counterintuitive. And then and this is what you find at the bottom of those cycles, bottoming and early uptrends: energy, oil, materials, staples, healthcare, Canadian dollar, etc. Small caps. And what should be not doing as well is gold should be topping. Technology is weakening, like you've seen over the last year, etc. And these things are starting to rock and roll. So we're seeing very good signs of that happening. So thanks to my buddies over at RBC. S&P 500 outperformed equal weight by 34% over the last 3 years, the widest 3-year performance gap in history. The prior record was 32% outperformance from 1997 to 1999, which was followed by a sharp reversal and 7 years of equal weight outperformance. You know, it's funny. People, it's amazing. Like values underperformed. Values underperformed the last few years. Equal weights underperformed the last few years, etc. And which makes me believe that I'm not a value investor. It is really what it comes down to. I think what I do is something really unique because we've dramatically outperformed over the past 3 years, and I think calling what we do value, there's an element of value, but I think the better way to think about it is private equity in the public markets, because value is just buying cheap stuff because it's cheap, and there's no turnaround, there's no catalyst, there's no anything. So I think I probably have to be a better communicator. I'm not so much a value investor as I'm kind of a turnaround specialist, but I guess we'll leave the labels aside. But the point of this chart is that the last time you had 3 years of equal weight underperformance, the next year was 2000, and the rest of the market dramatically outperformed the S&P. It was up 9.6 versus the S&P down 9.1. So that's kind of what he's alluding to here. Sharp reversal and 7 years of equal weight outperformance. So let's see if that proves to be the case. Would certainly be interesting. Trying to look for some precedent here. Large caps outperformed small caps by 5% in 2025, their 5th straight year of outperformance. That ties 1994 to 1998 for the longest streak of large cap outperformance ever. That prior streak was followed by 6 straight years of small cap outperformance. So the point is, he's saying for the next 7 years, odds are equal weight, aka the rest of the market that's not the top 10 weights of the Mag 7, is going to dramatically outperform. And also for the next 6 years, small caps going to outperform large. I would bet on both of those. Hard to say tech is in a bubble. I would bet on both of those, but not like a factor, like I will buy an ETF that will say this. It's not what we do. You know, what we're going to find is the bargains that we're taking advantage of are falling into those buckets by nature because of the characteristics of the financials underlying the stock ticker. So we don't go to those groups because the factor might work. We are in those groups because that factor is affording us the greatest opportunities to make doubles and triples over 3 or 4 years or more. And then you add the options, and then you get the huge alpha overlay and the whole thing. But so that's that. Okay, hard to say tech in this bubble. Valuations unchanged for the past 2 years versus surging during the final years of the tech bubble. Doesn't have to be a bubble to continue to consolidate. Apollo's investment in QXO. So QXO's up big. That's almost a double. It's not quite a double yet, but that's another one that's gone really quick. But that's when it's going to work over time. We're big fans of Brad Jacobs. Going to his book signing in person. He invited me on Monday. Super excited about that. Read his new book. He sent me an advanced copy. Super excited about that. Better than the first book. Definitely buy it when you can. AI spenders as capital intensive as oil majors. Watch the return on invested capital in both groups. So CapEx as a percentage of operating free cash flow. Oil majors, according to this chart, are at 50%, 55%, as is Google and Meta. And Amazon is at 90, Oracle's at 130. So that's why you see Oracle CDS blowing out. Comparing the US dollar returns in president's first year, 2017 versus 2025. That's interesting. Pretty much the same. Stock-based compensation prior to IPO and inflation-adjusted US 2025 dollar among major technology companies that have gone public since 2000. Stock-based compensation per employee. OpenAI is paying $1.5 million per employee on average to 4,000 workers, which represents nearly half of the company's 2025 revenue. Overall stock-based compensation as a share of annual revenue. These guys are pigs. We'll see if they get away with it. I remember the big IPO that everyone was all excited about. What the hell was it? They had this big old-time name guy. It wasn't OpenAI. It was some AI scam company. Anyway, it was a big deal and it complete dump. I don't think that will be the case necessarily with OpenAI, but at some point they got to start getting paid. Domestic box office totals having a tough time catching back up to pre-pandemic, but working towards there. Disney's getting all the money. 8 largest hyperscaler and semi-scaler market caps. Okay. Tech capital spending versus spending on U.S. infrastructure projects. Shows capital spending in 2025 versus spending on major U.S. infrastructure projects. Tech capex was close to the same combined. Hyperscaler cash and cash equivalents have dramatically fallen in the last 6 years. You can see in the case of Alphabet, their cash has gone from 45% as a total of percent of assets down to 20%. Amazon is down to 12 or 13%. Meta's gone from 40% down to 18%. So they're burning cash, ladies and gentlemen. So unless we see an imminent return, you're not going to see returns from them in 2027. I don't think you're going to see an imminent return. I think you're going to see it in 27, 28, maybe for some of them. And those are going to work. And that's going to help the last leg of the bull market over the last 4 or 5 years. But not yet. It's interesting. In a year, I have a feeling I'm going to be pounding the table on the Mag 7, but it's going to be from much lower levels. And everyone's going to be like, this guy's an idiot. Who could buy Mag 7 now? Just like we were in 2022 when we bought Amazon, Alphabet, and Amazon when you couldn't give it away in fall of 2022. Go back to the tape. Anyway, all right. So Jeff puts a bunch of stuff about the networking equipment depreciation assumptions. They've extended it to improve the appearance of earnings dramatically in the case of Microsoft, marginally in the case of Oracle, dramatically in the case of Google, and dramatically in the case of Meta. It's an accounting manipulation. And if you consider the life cycle of these, yes, they last a long time, but the technology is growing so fast, they're actually depreciating much faster. So if you were honest about the useful life or the life that it will be used, not the useful life, the life that it will be used, I think this schedule would be not at 6, but down at 2, and earnings would collapse. But that's not going to happen. But it's something to keep in mind if you're a stock analyst and buying these things when they're hyped up. Total assets of the Federal Reserve gone straight up since December 2026. They are buying bills all day long. QE Lite is back. And yeah, it was supposed to be just till April. Now it's going to be for the whole year. So that's going to keep us from having the normal average 18% midterm presidential cycle drawdown in the fall. I think it'll be more subdued, 10, 15%. Because liquidity is, and you had all the cuts last year as well. All right, what else we got here? Yield stocks versus the market. If you're not buying dividend stocks in an easing cycle, you haven't been around long enough, this is the time to do it. This is how you make a lot of money in a short period of time and own a lot of great companies for the long term. Because the big thing about dividend aristocrats in particular we have one in Hormel, is that, they've raised the dividend for 65 something years. It's not about locking in a 5% yield, which is probably the highest yield you could ever lock in. It's what happens is you wind up with a stock that you not only lock in a perpetual 5% yield, but to have afforded that yield, the stock is probably going to double over the next 3 to 5 years, if not more. And it's not just that the stock goes up and you collect all the dividends in the meantime. It's the compounding of the dividend. They raise the dividend every year. So you could wind up 7 years out with a stock that's up 150% and a 8, 9, 10% yield on your money and growing in perpetuity off of your basis. And that's the magic of dividend aristocrats when you can buy them at the right time in the cycle. It happens a couple times in a career. This was one of them. Most people are asleep at the wheel, but it's an exciting time to be paying attention to that. All right. Average income tax refund by year. This is going to jump $150 billion this year. That's going to be stimulative. That's what I think keeps the market in place and a little higher into April. And then I think we get some weakness, sell the news on the dovish Fed share. I could see a situation where he makes a mistake and appoints Warsh, and that's the catalyst for the weakness into the fall, or the perceived catalyst for the weakness into the fall. That he could make a mistake on the Fed appointment, because I'm kind of thinking, I'm looking at all the things, I'm looking at earnings, I'm looking at liquidity. I'm kind of saying, yeah, we probably hold up for the next four or so months before we hit into some weakness. Can make a lot of money over that period, and then get defensive and then buy stuff for the next 5 years in the fall. And choosing the wrong person would be a good catalyst for that. It could be anything, but that we'll see what happens. It's not a prediction. It's just an observation. Okay. So you can see 5 out of 7 Mag 7 stocks underperformed the S&P last year. Pretty exciting. If you were part of the Hedge Fund Tips community, you were prepared for that. Yeah, so this favors cyclicals. Aggressively from a guy named Craig Fuller. The LMI tracks the supply chain inventory cycle and has been very reliable in tracking intermediate freight demand. LMI peaked, by the way, this helps GXO in a big way. LMI peaked in February 2022, the start of the Great Freight Recession, a month before we published our article warning imminent freight recession. It also tracked the start of the 2017 freight bull run, the peak of the 2018 freight cycle, followed by the bloodbath of 2019. LMI indicates that inventory levels are the lowest they've been in a decade, suggesting that a massive bounce back is coming. Okay, so that helps quite a few names, and cyclicals in particular, which we're very well positioned for. Moving total of net foreign purchases. Okay. So when the foreigners are buying U.S. equities hand over fist, it's probably the time to buy international equities hand over fist, is what I'd be focused on. Lithium prices, this was another reason we took profits on Albemarle. They've had a big run. They're going to go higher, but I love the robot hype. Ladies and gentlemen, we've had robots forever. Okay, they're getting better at the margin. They're going to get better with AI. I think the most amazing thing is, and I'm a car guy. I've got a couple cars and all that stuff, but my wife's got a Tesla, and the thing literally drives itself. Like, you can't give these cars away. You literally can't give a Tesla away. And I live in California. You can't give a Tesla away. And you sit behind the wheel and the thing does all the work. It literally drives you. It's like you'd have to pay a human being $100,000 a year to be available 24/7 to drive you anywhere you wanted to go. And this thing does it for you. and you can't give away a tiny little Tesla for 70 grand. No one wants it. Point is that I don't know what the point is, but the point is yes, there will be humanoid robots, but it's not going to be perfect. By the way, we almost did get killed in it. Okay, so there's some blind spots. Like if you're at a stop sign like this, and the busy road's right here, it can't see around, so it pulls out, stops in the middle of the road. People come at you over their blind spot at 100 miles an hour, slam on the brakes and beep at you until the idiot car realizes that it's stuck. And it can't go backwards and it can't go forwards, and it just has to wait while the other lane's going 60 miles an hour past and not letting you in. And this whole 2 lanes is blocking you, and almost got killed, but you didn't. But other than that, how was the play, Mrs. Lincoln? They work great. And the point is that they're going to dramatically improve our lives, but they're not going to perfect it, is what it comes down to. These things, all these robots, how many of you have bought the Roomba vacuum your house thing? How many of you have 5 of those damn things because you always believed the new version was finally going to work? And the end of the day is you still have a housekeeper that has to come every single day and clean everything, because none of those robots work. Okay, and they've been out for 20 years, and they memorized your whole house and all the rooms, and they can't do stairs either, but whatever. And they still don't work. So they're going to be marginally helpful, but they're not going to be game changing yet. Active share dropping. Okay, what else we got here? Hedge fund exposures to cyclical. Hedge fund exposure to cyclicals and defensives have been increasing, so that's good. They got the memo. I think that's going to be the start of a multi-year long-term trend, like we saw from 11 to 17 there. It's improving, but near an all-time low, which is the times we like to buy. A lot of great data for you. I guess it's the new year. Everyone's back. S&P 500 companies signal inflation is set to fall. Okay. I think they might be surprised with energy going up this year, not down, right? Common narrative. Largest reserves in the world, Venezuela, blah, blah, blah. It's going to take 3 years. Marginal cost of barrel much higher. And I think energy is going to be higher this year. Short interest in TLT, record highs. This is going to continue to come out of this base. This looks like the PayPal chart. TLT and PayPal are going to rally this year. Let's just put it that way. Big tech contribution to the S&P returns in percentage points. 2025, they were 50% of the returns. Down from a peak of 83 in 2023. And that's interesting. Oh no, we did benefit from tech. And I was going to say, how do we have such a great year without tech? But we did. We had Google and we had Amazon off the lows 2022. Global earnings revision ratio turning up. Slingshot says, don't sleep on 2026. It's from Dietrich, who always has a bullish thing to say, and usually right, because market goes up 70% of the time. Okay, comes back up double digits. All right, this is interesting. So we used this data last year when we said, after the market corrects 15%, rallies to new all-time highs, you usually get an average 6.8% correction. You did get an average, you got exactly a 6.8% correction. I think it was in early December. Now he's saying that the next year return tends to be really good, up on average 19%. Listen, I wouldn't make that bet, but I won't turn it away. If it happens, it's whipped cream on the sundae, baby. If it doesn't happen, it's in line with our outlook for this year for the general indices. All right. Central bank hikers. Net hikes minus cuts quarterly. So we had record cuts last year. 300 something cuts. That's a lot of liquidity. Average change in average household earnings from OBBBA. What's OBBBA? It's probably what the income decile is probably what they're anticipating for the tax refunds. U.S. annual vehicle sales, 16.3 million in 2025. We are off the mat from 2020. Wait, 21, 22, 23, 24, 25. So what was the low? 122. Is this correct? This was around 14 million in 2022. Wow, we are recovering. And the peak again, remember, was in terms of production was 2017 when Cooper Standard earned $7.29 a share. When we get back to that peak this cycle, I think it earns $10 a share. So at a 10 times multiple, if you want to be conservative, it's a $100 stock. 20 times multiple, if you give it the same multiple it had at the last peak, should be a $200 stock. It peaked at 146 in 2017. China money supply is going up. It's going to bode well for Baba after Trump and Xi meet and shake a hand in April, which will mean May or June, because they're going to be arguing about little things. And then Trump's going to say, I need my picture. And then they're going to get together and shake. And Baba's going to go up another 30, 40%. U.S. tech sector has a very high earnings bar to jump over. We agree, especially their growth rate is declining. Top asset class returns last year, ex-US. We predicted that 2024. Go back to the tapes. You were set up for it. Emerging Marth, we not only predicted it, we took advantage of that with Baba in a major way. We took advantage of ex-US in a major way. Everything ex-US was the best. Worst return was cash. Everyone wanted you to be in cash. It's interesting. Warren Buffett's net worth, age 65 was $3 billion. Age 95 was $151 billion. The magic of compounding. Transportation index looks like it's breaking out. And you know what? The big thing that added to that today is going to be Baba got a huge order from Alaska Airlines, rocking and rolling. No one wanted it at 135. Everyone wants it at 230. They're going to want more at 300. We love that position. Animal Spirit Index looks like it's just roaring back off the lows we haven't seen since COVID, Great Financial Crisis, and 2002. Breadth is improving. Asset managers' net position on VIX. All right, so they're anticipating some volatility here. From that guy's usually bearish. VIX is kind of a less useful indicator than it had been for a number of reasons, but still worth keeping a little bit of an eye on. Leading countries by oil reserves, Venezuela. Why don't you overlay that with cost per barrel to take it out of the ground and refine it and bring it to market? And then you weight adjust it and you wind up with a completely different chart, but that would take too much work. Irrational exuberance allegations came too early. Okay, so people are saying we're going to go. I think they're right. I think we're going to consolidate, scare some people this year, and then rally big again, and AI will be part of that, and it'll be great. And Jensen, when the robot story dies, Jensen will start saying, you know, AI in the air. If you breathe it, it's AI. And he'll get his final run for NVIDIA for this cycle. ISM manufacturing PMI has remained in contraction for 10 consecutive months since 1950. It's generally been a positive time to be constructive. $12-month max loss was 2.4%. 12-month forward return is 18%. So when did that actually trigger? Triggered in 12/1 of 2025. So by November, they're anticipating 18, which would imply 12% for this year. Not outside the scheme of possibility. Leading index is pointing to ISM starting to recover, which helps all of our stocks. A lot of data. Wow. China allocations in hedge funds globally. At the top is 15%. It's still only 7.7%. So there's a lot more chasers coming to a theater near you, which we love. They hated it at 60. They barely like it at 150. They're going to start to salivate at 250, and they're not going to be able to help themselves at 300. And we're going to help them out. We're going to help them out and shove as many shares as into their pocket as they want to give us cash for. But in the meantime, we enjoy the show, sit back, pull out the popcorn, and watch the festivity and all the silly headlines. Every 2% pullback, there'll be a negative headline from our friend at Barron's. And then at 300, she'll get super bullish and help us get out of our stock. Small caps have finally started to see inflows. Amen, hallelujah. North American M&A volumes picking up. Animal spirits are back. This is a great chart. I bring it up probably every 6 months. Isaac Newton's nightmare, South Sea stock bubble. December 1718 to December 1721. Screenshot this, print it out, put it on your refrigerator. Never forget it. Put it on the back of your bathroom door so when you're sitting, you just stare at it and you never forget this. So in February of 1720, Newton invested a little bit in South Sea stock. He doubled or tripled his money. Looks like he doubled his money. He exits happy. His friends stuck with it. His friends got rich. Newton then buys back in at 4x out of where he sold after making a double, puts all his money in, goes up a little bit more. Newton exits broke 1 year, he exits broke. 4 months later, he loses his entire fortune. This pattern repeats, okay? Over and over and over. And I'm not going to point to what it could be this time, but you guys can use your imagination of different things that have these characteristics. If it smells like this, just avoid it. Let everyone else get rich. I mean, the secret to investing in what we do, okay? You can find people that trade and all that stuff. I don't know any of them that manage any real money, but you know, maybe they run few $1,000,000 of their own money and they make a couple $1,000,000 every year and they, looks good and that's fine. That's not a real business, but it's great. But if you're doing real investing, you got to pay attention to stuff like this. And you've got to either hire someone that has no FOMO gene or be damn sure you have no FOMO gene. And fact of the matter is, 99.9% of the population has a FOMO gene. It's designed to help us survive. If everyone's running to the exit, there's probably a fire. You should run to the exit. Okay. There's 0.1% of the human population that's genetically defected. Okay. I'm one of them. I don't have a FOMO gene. People get rich on stuff, NFTs. Okay. They got rich for 5 minutes. It just doesn't bother me. I'm super happy for people getting rich. I just stay in my lane and do what I do exceptionally well. And if you can learn how to do that, even if you're not going to be an investor, even if you're in a business and you got this beautiful, boring businesses that generates a huge amount of cash, and rather than get distracted by the new shiny object of the next new industry, why not just consolidate your industry and be the biggest and best in what you do, that you know best, that you're in your lane, that you've mastered, that you put in the time, that no one can compete with you, know what you know experientially because you put in the years. Just a food for thought. Retail risk on, risk off indicator. So retail is all amped up. Why the housing market frozen, mortgage payment to buy, monthly rent, mortgage payment, current owners. So maybe they'll do something with portability. Trump announced today he's not going to let institutions buy houses. I mean, open the federal land and let them build. Money managers total long and short position in WTI crude. Super net short, lower than they were even during COVID. this is a buy opportunity. MSCI Emerging Markets ETF breaking out after 20 years of consolidation. The longer the space, the longer the base, the higher the space. This is going to be a multi-year trend. And that's a good one to end on. Just ingrain this chart into your head because it probably goes maybe double from here over the next 5 years. And then the individual stocks like the BABAs, et cetera, get a lot more alpha relative to that. All right, next, articles of the week, start of something huge. Goldman now sees 20% upside in China. Welcome to the party. Same guy's downgrading BABA at 60. Consumer subsidies, but no one's worse than Morgan Stanley, by the way. Those guys were adamantly downgrading BABA in the 60s and 70s. No one's better because they were the same ones that were adamantly upgrading Alibaba over $300 a share. So they know what's what. 2026 consumer subsidies support markets. That's more stimulus coming in China. Turning point, China doubles IPOs in 2025 amid eased curbs to drive tech innovation. Amen, hallelujah. Ford reports best annual U.S. vehicle sales since 2019. GM posts 5.5% U.S. sales gain in 2025. Stellantis Jeep marks first increase in 7 years. Amen, hallelujah, Cooper Standard. Intel stock is so cheap compared to Taiwan Semiconductors that this analyst now says buy. Okay, it only had to double off the lows when no one wanted it. Everyone was downgrading it. Now everyone wants it. People are upgrading it. Expect a consolidation for some time because now everyone's hyped up after a double. So, you got your intrinsic value. Now you're playing the free option on the Lip-Bhutan, which is a really great free option, the fab, and advanced chip production. But you're basically fully priced for the legacy PC business at $45 a share. Intel shows off new computers that are central to comeback bid. You're already being paid for that. QXO's $1.2 billion investment means for the fragmented building materials industry. This is a great article in the HW, the Builders Daily. Stock keeps going up on us. We're super excited. What is our basis on that one? Oh, all right. Our initial basis was, all right, much lower. Paula's investment in QXO. So that's good. Continue to own that for the long term. The no-nonsense tech bro bidding to reboot PayPal. This is one of the best articles I've read on PayPal all year. It's from thetimes.com. You can find it at hedgefundtips.com under reads. Let's see if I can just show you how to get an article. So daily reads. By the way, if you're not on our daily email list, you can just put in your email here or at the pop-up, which I know you all love, at the website. But here's how you do it. What I'm reading today is the category. And then this one was so important. It's probably the lead picture right there. Boom. That's from Sunday. And the no-nonsense tech bro bidding reboot to PayPal. I thought it was just an article about them recooking in the UK. It's the best article on PayPal and what's coming that you could possibly read. All right, moving along. Disney says Zootopia 2 is China's top Hollywood film ever. Love that. Albemarle stock soars. It's the robots. That's from Al Root. That's when I say sold to you. I mean, I'm going to be wrong because it's going to go higher. The question is, when I look out 3 years, when I get 3x in 10 months, do I wait another 36 months for another 50%? And the answer is no, because that's below my expected IRR. So Avatar and Ash tops $1 billion globally as Hollywood hopes for blockbuster 2026. AI fatigue leaves investors focused on S&P's other 493 stocks. We've been saying this forever. Now everyone's coming alongside after seeing the results in 2025, which we predicted in 2024. Investors may go value hunting in 2026 as AI rally matures. Amen. Hallelujah. A 5 million% return in 60 years leaves Warren Buffett's legacy unmatched. That's a compounded annual gain of 19.9%, which is nearly double the S&P 500's 10.4%. And for those of you who have been with me for a few years, we are way ahead of schedule. So 1 year at a time, 1 year at a time. Alaska Airlines to buy more than 100 Boeing jets in Carrier's biggest order ever. And Big Pharma has more going for it than obesity drugs. It's an article in the Wall Street Journal about reversion to the mean and Pfizer being one of the laggards that could benefit. And we agree, and we're positioned accordingly. So now we're going to move on to the article of the week. Now we're going to get on to our newest pick in the article of the week, a healthier, smile ahead stock market and sentiment results. You can find all this at hedgefundtips.com. While you're there, click on terms. This is opinion, not advice. Consult your psychic before doing anything. Dentsply Sirona. My Sirona is what we've got going on here. This was initiated. You saw it on Varney & Co. on December 26th was the first time we went public with it. It was $11.06, and we have it, I think, across the board at $11.37. It's now starting to move along with healthcare, so we're pretty excited to see that early nascent stages of what will be a multi-year recovery in our view. And as you can see here, price follows free cash flow. It's no wonder the stock's down 83%. The free cash flow has been anemic. Margins have been contracting. And we put it through our turnaround Tom filter, and it just worked perfectly. Want to show you some things that are moving in the right direction. Obviously, free cash flow since 2023. Share count has come down quite a bit, which we like. Operating margins holding in there, and new CEO. So Dentsply Sirona is a new position for us, built over the last handful of sessions, last couple of weeks of the month at a blended basis of 1137. X-Ray marks our third name in the healthcare space, increasing our exposure to a sector we believe is well positioned for a catch-up trade in 2026 as the regulatory headwinds ease. Positioning and record underperformance mean revert, and the sector catches a bid from historical midterm cycle outperformance. For those of you who have missed previous episodes, healthcare tends to be up 9% versus the S&P, depending how far back you go, 2 to 4%. So it's just a dramatic outperformance. We discussed this broader healthcare theme in more detail in our recent Pfizer write-up a few weeks ago. You can click there. There's the segment from Varney & Co. Dentsply Sirona was born in 2016 from the $14.5 billion merger of equals between Dentsply International, founded in 1899, and Sirona Dental Systems, founded 1877. These guys have been around for a minute. X-Ray is the world's largest diversified manufacturer of dental equipment and supplies, spanning consumables, lab products, orthodontics, implants, and premium technologies. Nearly 2/3 of sales are generated outside the U.S., with a heavy concentration in Europe at around 40% of the revenue, positioning X-Ray as a key beneficiary of our view on multinationals benefiting from a weaker dollar environment. The dental industry is highly cyclical and is now inflecting out of a multi-year trough. Europe has faced an extended dental recession that is finally lifting, while the U.S. continues to face lingering headwinds with patient visits below pre-COVID levels and dental spending growth of 10% over the last 5 years versus 20% for healthcare overall. No company has felt the pain more than X-Ray, with shares down over 80% from 2021 peaks as the market continues to confuse cyclical drawdowns with permanent impairment. Dental spending lags healthcare spending. We see all these things here, practices down from the beginning of the year, etc. Nearly 30% of X-Ray's sales come from higher ticket CAD, CAM, and equipment offerings, tilting the mix toward premium products and elective procedures. This leaves Dentsply more exposed to cyclical drawdowns than peers focused on stable consumables and routine care as dentists defer financed purchases of big ticket items like CEREC systems, $100,000 plus, amid elevated interest rates amplifying near-term headwinds. Well, those are becoming tailwinds, ladies and gentlemen. End-to-end dental portfolio, you can see here breakdown by divisions. Essential dental solutions was 38%, 18% implants and prosthetics, 15% equipment and instruments, 13% CAD, CAM, 8% orthodontics, 8% well-spec'd healthcare. That's a different business. That's the bladder business. Global reach, only 36% of sales come from the US. So that's going to be a huge tailwind in terms of weak dollar as the recovery continues. Strategic capital deployment, they've been doing a lot of share repurchases as evidenced in the share count, which we like. Dividends, they can always cut. That's a lot of free cash flow. So that said, long-term fundamentals for the $30 billion plus global dental supplies and equipment market remain highly attractive, driven by powerful secular tailwinds, aging populations requiring more restorative care, rising demand for aesthetic treatments, a broader shift toward preventive dentistry, and the clear advantages of single-visit chair-side workflows. X-Ray stands as a clear leader in this space, and with a chair-side CAD/CAM adoption still early stage, less than 20% adopted by U.S. dentists, there remains a long runway for CEREC and related digital solutions to continue gaining share from traditional lab-based methods. Not all of X-Ray's recent weakness stems solely from the cyclical downturn. Prior management also grappled with self-inflicted missteps, most notably the 2021 acquisition of Byte. Dentsply paid $1 billion, nearly 6 times sales, for the margin dilutive direct-to-consumer clear aligner business at the very peak of the aligner cycle. What a dumbass. While Byte initially became one of Dentsply's fastest growing products, the deal ultimately unraveled after the company suspended DTC sales and marketing following discussions with the FDA, resulting in significant write-downs and impairment charges. Management has undertaken significant heavy lifting over the past few years to course correct and stabilize the business, achieving nearly $300 million in run rate cost savings, reducing global headcount by 8 to 10%, executing a 60% SKU rationalization to focus on the less than 15% of products generating 90% of revenue, reducing the manufacturing footprint by 15 to 25%, and consolidating from 14 ERP systems to a single platform by the end of 2026. While these efforts represented the tough but necessary medicine needed to reset the business, the focus on cost cutting came at the expense of customer relationships, distributor engagement, and commercial execution. Top line growth has remained under pressure, effectively bringing the business to what we view as the 10-yard line of the turnaround and setting the stage for a fresh set of eyes at the CEO level to come in and spike the ball. You know, when I was doing diligence on this, I have a friend who owns a competitor. It's a very large business in Orange County, and he walked me through the factory, and he said that, you know, there's an old joke about Dentsply Sirona, and he said, you know, they never stop calling you until you buy the product that they're trying to sell, which was music to my ears. And but he added, what's the number one way to get a Dentsply Sirona salesman to stop calling you? And the answer was buy the product. So apparently they're good at selling, not so great with customer care. I'm sure that's an initiative that they're going to fix. So I think we're at another situation here where we're at the 10-yard. A lot of the turnaround is, the heavy lift is done. And now you've got the fresh set of eyes with Daniel Scavia that can come in and spike the ball. Very similar to what you saw in Intel that went up very, very quickly for us. The final push comes with the appointment of Dan Scavia, named CEO effective August 1st, 2025. After joining the board earlier in the year, Scavia is a proven operator with a track record that speaks for itself, most recently serving as the CEO of Globus Medical, a leading spine technology company. During his decade-long tenure at GMed, where he first served as CFO, then CCO, and ultimately CEO, the stock became a four-bagger. Scavia also orchestrated the 2023 $3 billion NuVasive acquisition, the largest deal in company history, and successfully integrated the business to create the number 2 spine player. Prior to Globus, he spent 28 years in leadership roles across various businesses at Johnson & Johnson. Here's a great interview from a few months ago with Dan Scavia and Max Miltz, VP of Connected Technology Solutions, covering Scavia's background, the X-ray turnaround, and the long-term vision. I'll let you watch that at your leisure. We view Scavia as a major catalyst in the X-ray turnaround, bringing an integration skill set and a roll-up-your-sleeves commercial mindset the company has been missing, especially given lingering questions around synergies between Dentsply and Sirona and the value still to be unlocked. He has quickly recruited proven talent, including Aldo Denti from J&J as Chief Commercial Officer and Dustin Shields from Globus as Chief Transformation Officer. Scavia has outlined clear early priorities, a return to growth plan centered on fixing the U.S. business through expanded dealer partnerships, restructured commercial solutions, and ramping R&D from 4% to 7% of sales to strengthen the product portfolio. He's personally re-engaged major dealers such as Henry Schein and Patterson, marking a sharp pivot from prior management's approach, all aimed at restoring profitable growth. With much of the margin work already completed, combined with ongoing savings and integration benefits, we see a path to SG&A closer to 30% in line with peers and gross margins returning to historical mid-50% range. As the top line accelerates and operating leverage kicks in, we expect X-ray to move back toward the low 20% EBITDA margins, with free cash flow returning to historical levels of $400 million plus as the turnaround plays out. As we often say, we favor businesses with multiple outs, and X-ray offers several. One of the most underappreciated is the well-spec'd segment, a leading provider of bladder and bowel care products. This high-margin business accounts for 8% of sales and generates 40% of free cash flow while constantly posting mid-single-digit growth. Management made the right decision to retain the business following a strategic review, recognizing untapped late-stage investments and the risk that a spin would undervalue the asset. We see WellSpect as providing essential dry powder to fund the dental recovery, plus meaningful optionality down the road, potentially worth more than half the current market cap if ever separated. Despite this setup, the market remains stubbornly pessimistic on the turnaround, pricing X-ray like it's getting taken out on a stretcher. The stock trades at just over 7 times forward earnings, 60% discount to historical averages, and 0.6 times sales, 75% discount, the cheapest valuation in decades. And they've had a lot of decades, ladies and gentlemen, more than 12. Not many people can say that. So investors are paid to wait with a 5.7% dividend yield. If management ever needed additional flexibility, which we do not expect, suspending the dividend would free up $120 million of incremental free cash flow, providing yet another out for the turnaround. The dividend is supported by a solid balance sheet with net leverage of 3.1 times and the bulk of long-term debt maturing in 2030 and beyond. As deleveraging continues through the recovery, management has a $1.2 billion share repurchase authorization at their disposal to retire more cheap shares. This setup has all the hallmarks of a classic turnaround Tom special, an industry leader with a long operating history, emerging from a cyclical trough with self-help largely complete, a proven new management team focused on growth, and a valuation that prices in permanent impairment. We're happy to sit tight and get paid to wait for what we see as the potential for a triple over the next 3 years as growth returns, earnings normalize, and multiples re-rate from left for dead levels. Here's more detailed look at the business and turnaround strategy from a prior investor day. We've highlighted and starred the key points. You can check it out at hedgefundtips.com. We also went through most recent earnings and earnings call, so you can be up to speed on that. 10 key points. Net sales from Q3 were $904 million, down 5% as reported and 8% in constant currency. FX was a $28 million tailwind during the quarter, a key part of our view on multinationals benefiting from a weaker dollar environment. Roughly 5.5% of the decline was driven by the Q3 2024 Byte impact and ERP pre-buy, both one-time headwinds. Number 2, adjusted gross margins of 52.6% declined from 55.3% last year as sales mix and tariff impacts, an $80 million annualized headwind weighed on results. Despite this, adjusted EBITDA margins expanded 50 basis points to 18.4%, and cost cuts and lower OPEX began to show through. 3, management announced a return to growth action plan, a 4-pillar strategy aimed at improving performance and positioning the company for sustained profitable growth over the next 24 months. The top priority is reigniting the U.S. business through improved commercial execution, streamlined operations, and reduced complexity, with expectations for sequential improvement throughout 2026. 4, as part of the turnaround, management is making leadership changes as new CEO Dan Scavilla builds out his team. X-Ray announced the departure of CFO Matt Garth, who joined in May and was, quote, not the right fit. Scavilla appointed Aldo Denti as Chief Commercial Officer, a former colleague from J&J with 25 years experience across medical devices and consumer health. Dustin Shields, who was named Chief Transformation Officer, joining Globus Medical and tasked with overseeing day-to-day execution of the Return to Growth plan. 5, management announced that the WellSpec segment, which had previously been under strategic review, will be retained and play a key role in achieving the company's financial goals. We agree with this decision. The high margin business continues to be a bright spot in the portfolio, posting 9.3% constant currency growth and 15.6% reported growth, with volumes higher across all 3 regions. 6, a key piece of the new CEO Dan Scavilla's strategy is expanding the network of U.S. dealer partners in CTS to accelerate market penetration, improve dealer relationships, marking a clear pivot from prior management's approach to distributors. Scavilla has already begun re-engaging with dealers, personally speaking with the CEOs of Henry Schein and Patterson, and expects these partnerships to be firmly in place next year in a way that is mutually beneficial. 7, management announced plans to accelerate R&D investment and improve the health of the commercial engine, pulling forward millions of dollars into Q4 and targeting annual R&D spend of 6 to 7% of sales, a historic average of 4%. 8, operating cash flow in Q3 totaled $79 million versus $41 million last year, as unfavorable working capital movements weighed on results. Adjusted free cash flow was $40 million compared to $98 million for the prior year period, with conversion declining to 54% from 97%. Cash and cash equivalents remained solid at $363 million at quarter end. 9, the U.S. business remained under pressure in Q3 as the dental slump continued, with sales declining 22.2%, driven by weakness across essential dental solutions, CAD/CAM imaging, and implants, partially offset by strong performance in treatment centers and WellCare, which is the WellSpec bladder business. The decline includes a 12.5% impact from Byte and the ERP pre-buy, and excluding these non-recurring headwinds, sales were down 9.7%. 10, management reduced full-year guidance, now expecting a 4 to 5% sales decline in constant currency versus the prior 2 to 4% decline, while maintaining a reported sales of $3.6 to $3.7 billion compared to fiscal year 2024 revenue of $3.79 billion. Adjusted EBITDA margins are now expected to be greater than 18%, down from greater than 19%, but up from 16.6% in fiscal year 2024, with adjusted EPS guided to $1.60 versus $1.67 in fiscal year 2024 and the prior $1.80 to $2 range. Here are the earnings call highlights, and you want to go through those. We've highlighted the key points. General market sentiment at neutral. We're closing out the Q1 opening for the small accounts, the $1 million plus. If you're interested, you got to get your information in today. We're going to close this thing out on Friday the 9th. So $5 million plus, you can come in anytime you want. And for the 1 million, if you missed this, we'll likely open up sometime in April. Moving along. Oil and gas equipment and service earnings estimates and revisions, top 30 weights revised up 1.42% in the last 60 days. ARC Innovation, give us an idea of the Momo stocks. revised down 4.01%. So cyclicals is moving in the right direction. The shiny objects seem to be stalling. We have a lot of Ask Me Anything questions to catch up with. So we're going to do that. First and foremost comes from Jens Lundstrom. Can you provide your opinion on VTEX? Let's take a look, Jens. Okay, VTEX. All right, looks like cash flows inflecting, margins are inflecting, revenues have been flat. What type of business is this? Please don't tell me it's a software business. Software as a service, digital commerce platform for enterprise brands and retailers. Commerce strategy, build online stores. So it's a Me Too Shopify. 3 times sales. Let's see. I mean, this is a speculative stock. You really have to understand the product and what is their moat, or is it just another Me Too that's going to get competed away? Not something we do, but I definitely like the financials, the direction the financials are moving. So maybe you're onto something, but that's a speculative stock for us. Matthew Wortley, hope you had a great Christmas. Organon OGN. Okay. I mean, they've just been doing nothing for years. OGN. This does not want to work. There we go. Prescription therapy. Yeah, this one I've looked at this one a few times. It's gone in the too hard box. I mean, I don't think you're not going out of business. That's for sure. I just don't know what the catalyst is for growth. Let's see here. I mean, it looks like a runoff business is what it looks like. Health, contraception, and fertility brands. Biosimilars. This might be. Yeah, this is generics, which have just been left for dead. Yeah, I mean, look, you got a decent enough margin of safety. Let me check the balance sheet real quick. Yeah, they put a lot of debt on this thing, $9 billion of debt. You just, if you want to dig further into it, you just want to listen to the last 8 conference calls and find out what their plan is for growth. I don't think you're going to get hurt, but I wouldn't be. It's not the highest and best use of capital. GE Healthcare, GEHC. So it's up 40%. GEHC. All healthcare is going to work. I don't think this is the highest and best use in the sector, but you should be okay with this. I don't, you can't, for us to get interested in a stock, it's got to be a double or triple minimum over a few years. GIS, I think we've covered this a million times. We're okay with it. General Mills, yeah, it's fine. Abhishek, well, let's just take a look at the numbers real quick again. Yeah, I mean, it's a decent stock for 2026. It's not a great company generally anymore, but okay. Thank you for consistent wisdom, Tom. Do you have any insights on paychecks? Tough to buy these at the beginning of employment weakening, and it hasn't really come down enough relative to that risk. I think it's okay long term, not a good use of money here. Owens and Minor. This is from Lucas Borger. And no, it didn't come on my radar next to Dentsply. This one's got more problems. Why is this not coming up? Okay. Yeah, I can't find that one. I think it was acquired. So just double check on that. Send me a ticker next time. Next. Martin Florini, thoughts on FMC at these levels? We've covered that a million times. High risk, high reward. Nothing I would put clients in because you could lose all of your money, but I think it's going to work and you're going to wind up with a multi-bagger. I kind of like it here for a PA with adequate weighting, responsible weighting, because you treat it like an option, which you wouldn't put more than 1 to 2% of equity. And if you're right, you make 5x. If you're wrong, you lose 1 to 2% of your equity, which is the type of asymmetry you want to play with a business like this. But the problem you got here is continued declining revenues and negative free cash flow. That doesn't mean it's going out of business. Let's take a look at the balance sheet. $500 million in cash, whatever. Yeah, $500 million in cash, $3.2 billion of debt. And they just, let's see if they're quarterly, how's their quarterly free cash flow doing? Are they inflecting at all? No, 2 out of the last 4 quarters were big negative free cash flow. I mean, the problem is it's trading like it's going out of business. I don't think it probably is. Crop protections. I think exactly what I said. You got to treat it like an option. If you're right, it's 5x. If you're wrong, you lose 1 to 2% equity, and you do it in a personal account. Zachary Illies, again, this is all opinion, not advice. Go to Hedge Fund Tips, click on terms. Zach, Clorox, raising dividend, buying back stock, earnings are beating, chart looks awful. Thanks for literally making me rich with Alibaba and Comstock. Zach, well, congratulations on being rich. Welcome to the club. Hope many more of you are joining us as the days go by. And it's all relative. Clorox, we've covered a bunch of times. We like this one long term. Good job and congrats. Nikolai Johnson, thanks for a very good podcast. Which of the companies in your portfolio have the greatest upside potential from current levels? You're asking me to pick my favorite kid. Here's a guy who wants all of the sweets with none of the love handles. Not happening today, my man. Adam Hughes. Tom, we're trying to teach you how to fish, not give you a fish. Although we've given out a lot of fishes and a lot of you have reciprocated and become clients after, as the other gentleman said, getting rich. So we're grateful for that as well. Adam Hughes, look at NVO. We've covered that 5 or 10 times in the last couple of months. We're fine with it. Annabelle, thoughts on Cooper companies. Let's take a look there. It's already had a pretty big move off the lows, almost 50%. So let's see here. Yeah, will it follow through in the mortgage business? Yes, this game is back on. I have no problem with this one, but it's not the highest and best use of cash, and there's very low probability I make a double in a reasonable amount of time, so not for us. But it's going to go up. Will G, thoughts on Newell Brands? No. They had I don't know if they got a new CEO yet, but she ran it into the ground. How do you screw up Sharpie, Graco Strollers, Coleman, Elmer's Glue, Rubbermaid, Marmo, others? I mean, you have to work 7 days a week, 24 hours a day to destroy a business that's this good. I cannot stand inept management. The answer is no. They destroyed the damn thing. If you want to play it like an option, let's see. Let's just see if they have a balance sheet left anymore. Let's see. Still free cash flow negative. Revenue still declining. Margins. Yeah. Who's the CEO of this thing? Is it still the same lady? I mean, how do you screw that up? Leadership team. Oh, okay, let's see. Chris Peterson, former CFO. So he's not really an operator. May 2023. He hasn't really accomplished much. Again, I think, let me just see what the balance sheet looks like. $200 million of cash, 800 of receivables, 5 billion of debt, which they paid down from 7. I mean, it's just a call option. 1 to 2% of equity. If you're right, you make 5x. If you're wrong, you lose 1 to 2% and live another day to tell the story. It's what you do in your 20s. Coin. This is not my... I think all these other brokerages are getting crypto, so I don't know how Coin's going to have an edge when you got Robinhood and all these other guys. I think the way to play it is the way we talked about with Andrew, with Ethereum and all that's going to happen with that over time. But that's not my area of expertise. I'm deferring to a guy who's really smart and really good at what he does. And I think he's going to be right about predicting the future, about how that sector is going to play out. And I think he's going to make a ton of money over the next 5 to 10, ton more money over the next 5 to 10 years with his ether machine. But these brokerages, they all get commoditized over time. So it's not for me. Jack Hazard, Middleby. I think that's a pretty interesting name I've been looking at myself. It's kind of a backdoor way to play the restaurant recovery. They're better. I prefer the restaurants, number one. Number two, you kind of missed it. It's up 50%. So a little late on that one. Not a stock. This is from Tim Wells. Not a stock question, but what advice would you give to a 25-year-old Tom Hayes? Do you think the 25-year-old version of you would be able to believe all the success the present-day version of you has achieved? That's a good question. The answer is yes. I think you have to. I would say yes, because you have to visualize it before it happens. But I would also say no, because, I've already achieved with Great Hill Capital well beyond anything I set out to do when I set it up. So, so now I've set bigger goals, because I think, one thing I learned from Jim Rohn, who was Tony Robbins' mentor, when I was in my 20s, was if you don't produce, you won't be happy. And the fulfillment in life, a lot of people say, I want to be happy, blah, blah, blah. I think people want to be fulfilled, and fulfilled comes from overcoming obstacles and triumphing. That's the joy. You can see it in people's step when they live that type of life. There are a lot of people out there with a lot of money that don't have the joy of having had the struggle. And it's not good or bad. Some people are just born that way. And, but I don't envy them, because they didn't have the joy of getting kicked in the teeth and then coming out the other side into the sunlight. So the answer is, the advice I would say is two things. Number one, I never look back. I only look forward. So is there a coulda, shoulda, woulda in there? There's absolutely not. I wouldn't trade any of the ups, any of the downs for anything in the world, because it made me who I am today and made me learn the things that I learned that you guys are able to benefit from, and we can continue to grow together in the coming years. So the answer to your question is, you're not going to figure it out in 25. Just try. The difference between you getting beyond where you think you're ever going to get and not is getting up one more time than the rest of the people, because what you're going to find out is that most of your peers in their mid-30s are going to give up. And they're going to just settle into some, above the median lifestyle where they can look good and fit in and justify and all that stuff, but they're never going to grow, and they're never going to be willing to take a risk, because they never want to make a mistake and look bad or fail. Fail is great if you don't stop. If you do stop after failing, you are a failure. If you continue to go after you fail, you're guaranteed to be a success, because you just never stop until failure, 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 success. And you only have to get rich once. So all I would say to you is go after it. 20 years from now, you're just going to want to look back and say, you're going to prefer if things work out great, but you want regret minimization is what I'm trying to tell you. And if you have an idea in your mind that you want to do, just go out and do it. Don't do what you think is going to make you the most amount of money in the shortest amount of time so that you can have this car or this, that, and look good and this and that, because you're just going to fail. Okay. Go do the thing that you love to do, that you think you can do well, that provides a lot of value to a tremendous amount of people. If you can provide a lot of value to a tremendous amount of people, whatever industry you're in, you're going to do exceptionally well. So, answer to your question is, I have no advice for a 25-year-old Tom. Just keep getting up. And that was the name of the game. Keep working and keep getting up. Dan Gherkin. I don't know if this is a question. I'm a very grateful retailer, end quote. My portfolio in 2025 increased over 31% net, which was a gain of over $600,000 after taxes. And this was done without use of options and keeping cash levels between 40 to 60%. I've been following you since July 2024. Thank you so much for being there for us retailers. And yes, I've already recommended hedge fund tips with Tom Hayes to my best friend, and also sent you a 2025 Christmas card. Okay, well, thank you very much. That's very kind. And by the way, as a reminder, all we ask in return, look, a lot of you guys make a ton of money off of this thing and you'll never do anything with us. And we're just grateful that you listen in and support us. For those of you who want to give back, a lot of you have shared it with one or two people that you care about that could benefit from this information to help them. That's the greatest compliment you can pay. And the rest of you, at the end of the day, you figure out it's in your own, if you have the means to become clients, sooner or later you figure out it's in your interest to become clients. So that's not giving back, that's doing what's in your self-interest. And many of you have done that, and I'm very grateful for that. Okay. Chris Brooker says, hey, Tom, love to hear your thoughts on how to read the market when volumes are so slow. I have stocks that have risen significantly, but only with half the usual daily volume. Does this suggest the price is built on thin ice? I don't think about businesses that way. We are doing private equity in the public markets. So if I own a Jersey Mike's Subway, I look at the cash register. Is free cash flow going up or going down? Then the business is going up and going down. I don't care about light volume, heavy volume, this or that. When it's despondent and no one wants it and it's trading dramatically below intrinsic value, we buy it. When it's trading euphoric, whether it's on triple the volume, half the volume, it doesn't matter. If it's a ridiculous price, we're going to help people out and give them all the shares they want. Okay. So I would stop paying attention to these little trading nonsense things that you think have any indication of the intrinsic value of the business, because this is what's going to separate you from your money sooner or later. What's going to get you a lot of money over time is learning how to analyze the business. And that's why we come here every week and do this for you. So Isabella Lamb, thank you for the question. Thoughts on WNC? Trucking recovery play. Okay. Wabash. I don't see any recovery yet. So I would get on some of the calls and start to understand when and how that's coming. But you're probably okay. And by the time you get indication that it's coming, you already missed a double. So let's just make sure the balance sheet's okay. $115 million of cash, $154 million of receivables, and the debt three. Yeah, this seems okay. Yeah, you probably wind up with a double over the next few years, maybe more. Good job. John Barry, if you were looking for another position with Albemarle and Materials, would you consider Freeport-McMoRan? This is a guy who, well, all right, let's take a look, John. We've looked at this one before. So for those of you who haven't been following, we gave Albemarle in the 50s and 60s, and it's just skyrocketed. We took a few profits. We still have a huge position in it. We're watching it, but it just, this is gonna go up over time. I mean, this was a triple so much faster than we expected. So let's take a look at FCX. I generally don't like this company, but what's the new trend? Prove me wrong, convince me otherwise. I mean, why are you buying it up 20x? So it's going to quote unquote break out. This is a trade. This is not an investment. I don't buy things up. Never have, never will. But thank you for the question. Could it go higher? Of course. Could it quote unquote break out from a 15-year base? Yes. But I just don't do it. Not for me. Jignesh Salia. I want to sincerely thank you for all your valuable podcasts and videos you share. I was introduced to your content by my cousin at the beginning of 2025. Yeehaw, thank you. And since I've been following your work closely. Okay. In April 2025, during a market dip, I invested in a few quality stocks based on your insights from your videos and held them patiently. I'm happy to say 2025 turned out to be one of my best investing years, and your guidance played a big role in that. I've also started recommending your videos to my family and friends because of how insightful and grounded your analysis is. Thank you again for your generous guidance and wishing you a happy new year. Thank you. I had one question I was hoping to get your thoughts on. Rocket companies. All right, Jignesh, let's take a look. RKT, I think I'm going to like this one. Time is right for these mortgage businesses. I mean, you kind of missed it. Am I missing something here? Hold on for a second. It's up 5x off the bottom, man. 4x. I mean, can you get some follow through? I think secular theme is correct. I just don't like to buy things up 4x. I like to buy them when no one wants them. Right now, a lot of people want it. Maybe it's going to double again. More people want it, but you got to buy things when they're in the gutter, okay? Buy them on red days. Buy them when no one wants them. Don't buy them after a huge move. That's trading. It's a different way to make money. There's nothing wrong with that, but you can't. We do private equity in the public markets. That's momentum chasing, and that's for other people. Jimmy Jones, wishing you a happy new year. What are your thoughts about the Venezuela rebuild? Varco is going to be a home run exclusive of Venezuela, and now we just got this free double tailwind from Venezuela. Over the next 3 years, Varco is going to make so much money, they have no idea what to do with it. And that's been another hit for us that's just getting started. NOV. Michael Mendocino. Clorox, yeah, fine. Bob Seeger. Medtronic, yeah, fine. Covered it a million times. No, that's Medifast. MDT. Why do you want to buy Medtronic? You kind of missed a double off the bottom already. Buy Baxter. What are you thinking, my man? Opinion, not advice. Baxter's just starting to go. I'm telling you guys, let me just tell you, we like that one. Panagiotis Natulis. Thank you for the big thank you. Lamb Weston. Oh, so greetings from Greece. Writing and let you know I discovered your channel in 2025. Feel you've been providing truly invaluable help to me. Oh, you a really big thank you. Opinion on Lamb Weston. All right. LW. This is what, frozen food or something? Seems to be inflecting a little bit here. Balance sheet. Little light on cash. What's going on with these guys? Receivables, how much debt? Yeah, I just want to understand that cash situation. What's happening with free cash flow? It might be a timing issue, but yeah, it's not without risk. I would listen to the last 8 calls, understand what's going on, what they're saying about leverage, the balance sheet, etc. But you're probably okay from these levels. GENC, but you got to do the work. GENC, and it wouldn't be my first choice, but I think it's going to work for you. Gencore Industries. Here's a stock that's done nothing for 20 years. Why would it start now? Let's see. GENC. Maybe because the fundamentals are improving. Well, the revenues are. Cash flows mixed. What do these guys do? Highway construction materials, mixed asphalt. Okay, so this is kind of tied to rates and the housing and blah, blah, blah. I just don't think I'm going to get a quick double on it, but I think it'll probably work for you. So with that said, I do want to thank everyone for tuning in This was wonderful. I missed the AMA last week. I'm so happy we got to do it this week. If you got your questions in today and I missed them, we're going to get to them next week. With that said, we'll be back next week on our normal time, normal place. In the meantime, make it a great one. Bye for now.